Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're gonna give a crash course on velocity banking for dummies. Now, if you never heard of the term dummy, it might be a little bit outdated, but basically it's this little human prototype here that's purposely put in cars so that they can crash and people can, so that, automobile engineers can figure out like, oh, is this car safe or not? But hopefully after this course, you won't be crashing with your financials. You'll be on your way to success. But yeah, so let's just get to it. So we're going to just kind of break down velocity banking in its most simplest terms. So before we actually dig into the strategy, there's just a few key terms that you have to know. First one is just a line of credit. So what's a line of credit? So basically it's a financial tool where you could borrow money, pay it back, and then reuse it over and over again. So like a credit card. If you've heard of a credit card, that's basically a line of credit, but there's other types of lines of credit that people may not be familiar with. They might not be familiar with the personal business home equity line of credit, but they're certainly familiar with loans. So the kind of the other tool that the banks have at their arsenal is a loan, right? So a loan is a one-way street. If I borrow $10,000 in a loan and I repay that loan, I can't ever use it again unless I get another loan, right? So that's just kind of like the difference where line of credit is just a two-way street. You can borrow, pay back, reuse it over and again. And a loan is just a one-way street. Okay. Now, there are several types of lines of credit. So it's kind of tied to a personal situation, but these three are mostly the same. The personal one is based on you, is tied to you yourself. So if you're John Doe, you're going to have a line of credit tied to you, John Doe, right? If you have a business like, Fun Times LLC, then it's going to be based on your business, right? So that's really the only difference between personal and business. Just who is it tied to? Home equity, this is still tied to probably you, John Doe, but they're going to use your home as collateral or security. And so, basic rule of thumb, the more you put up as collateral when it comes to credit, the more they give you in terms of like better interest rates and limits in general. So this is tied to your home or the value of your home minus any loans. Credit card. A credit card is a line of credit. Now, it's not exactly like these three types of lines of credit. There are some restrictions. Ones that come off the top of my head is first, you can't use a credit card to pay another credit card, right? That's one. Second restriction is that you cannot pay off loans with a credit card with some exceptions, right? But here's the other thing. Here's the really cool thing about these first three lines of credit. I can borrow like $100, and then let's say the next month I have to pay the minimum payment, which is like $25. I could just borrow from the same line of credit and repay it back, right? So it's like robbing Peter to pay Peter, or something like that. I don't know if that's the right phrase, but you can do that with the line of credit, like the personal business home equity, but you can't do that with the credit card. So just be aware that that is possible. Now, what's the strategy? So what you're going to do is you're going to get something called line of credit. It should have a big limit to handle consolidating debts, and so that when you consolidate debts, you free up your cash flow, right? So basically, what happens is you get the line of credit, you put your entire paycheck to the line of credit, you pay your expenses with the line of credit, and then rinse and repeat. It's like, wow, is it really that easy? Yeah, paycheck in, expenses out. So it's like, okay, instead of using your checking account as your main operating account, it's going to be one of these. It could even be a credit card if possible, right? I know there's some restrictions, but you could still work with a credit card. So paycheck in, expenses out from line of credit, rinse and repeat over and over again. And then the goal is you pay off the debt, more debts that are paid off, you increase cash flow, and you win. And you increase the speed at which the debt's paid off. So here I am. So here's the thing. Some people have been asking me on my YouTube channel or on this YouTube channel, like, hey, can I get the spreadsheet? But this spreadsheet is so basic, simple. Like, we'll give it to you, but you can create it on your own, right? All you have to do is just write one column, average American, and then what you have to do, first step is always have a budget, right? So what's your paycheck? How much are you bringing in? And I always like to use the same examples over and over again because repetition is the mother of all learning. So let's say you have a paycheck, $5,000, expenses $3,000, and then after all expenses are paid, you have savings of $2,000. Now here we write zero cash flow, and what the reason why we write that is because usually your savings are meant to kind of be locked away, similar to a 401k, but not like until age 59 and a half, right? But kind of similar. Like maybe you're not really meant to touch your savings. It's meant to be like an emergency thing. So you kind of pay your expenses, get your savings, and then once you have that emergency or maybe a down payment for home, then that's when you apply it. So it's not anything liquid that you can actively use, right? So that would be zero cash flow. Now, once we've done that, we have our expense breakdown, right? And so here we have expense breakdown, student loan, car loan, rent, other things. Now here's the really most important part about doing an expense breakdown. Every single debt that you have is going to be its own line item. You gotta make sure that every debt is line in its own line item, so you can know when the debt is paid off how much cash flow you're going to recover. So what's the expense here? $400 payment. Oh, let me unstrike this because I was doing this demonstration over and over again. Okay, so now we have a $400 payment here, so that's how much the expense is taking up monthly. $600 here. Again, these are averages, right? So that's the average student loan payment, average car loan. This isn't the beginning balance of the student loan. Maybe you've paid it for some time, and that's why it's a $10,000 balance. But it should probably, if it's the beginning of the loan, it's obviously going to be a lot bigger. Same with the car loan, right? $600 rent, we'll say $1,000, and other food is $1,000. Now you can combine the food, rent, and the other, but you cannot combine the debts when you're doing the expense breakdown, because we're going to see that once we eliminate the debts, then our cash flow increases. Whereas, this is always going to be there no matter what. The rent and the other always going to be there. Okay. So now, after we've done that, now we got to select our tool, our line of credit that we're going to use as an operating account. So for the average American, the paycheck goes into a checking account, and that's the operating account, right? I mean, it's like, yeah, isn't that normal? No, not when you do it the velocity banking way, and you'll see why. So we just pay our expenses. We have our savings of $2,000, and we're going to be paying this debt for a couple more years at least. And so, yeah, if we have a $2,000 emergency, I guess, we can use that money from our savings, but we'd prefer to not touch it. So it's a little bit inflexible, right? But if we do it the velocity banking way, we're going to still have our $5,000 paycheck, but we're going to have a line of credit. So this may be a HELOC. We'll just assume we got a personal line of credit at 15% interest rate. And the bank was generous to say, you know what? You're making decent money. You pay your bills on time. You have a good credit profile. We're going to give you a $25,000 limit. And you'd be like, all right, cool, $25,000. Now, what do you do here? Right? So let's go back to our notes. And it says put the entire paycheck to a line of credit, right? So right now we haven't used up any money in the line of credit, but what can we do to put some debts on there and increase our cash flow? Well, we have these two loans, right? So we have these two loans, and all we have to do, so if we sum up the balance, it's 23,000. All we have to do is just move these loan balances to here to the line of credit, and you can do that because the line of credit is just pretty much like cash. You just withdraw cash from the line of credit to your bank account, pay the loans, and then you have a balance of 23,000, right? 23,000. So now what happens here? These loans get eliminated, right? So let's strike those out. If these get eliminated, essentially they become zero in the velocity banking way, right? They become zero. And so what happens? Rent's still there. All the other stuff is still there. This doesn't magically change because of velocity banking, but these go to zero. So what happens? The expenses, if you sum them up, go to $2,000, right? And here's the other thing. We're not going to have savings because we're tired. What we're doing is that we're applying our entire paycheck to that line of credit to bring down the balance, and then using our cash flow of $3,000 to know how much we're gonna have as the next month's balance, right? So I put in 5,000, it goes down to 18,000. So 23 minus 5,000 to 18,000, and then eventually my expenses will creep up 2,000. So every month, this balance will go down 3,000, right? And then we're not counting for interest. We're going to just do it a little bit separately just to see, visualize it easier. I know it's not technically correct, but the math will be very similar. The numbers will come out mostly the same, approximately the same. All right. So how do we calculate the next month's balance? But basically, it's just the previous month's balance minus the cash flow, which is 3,000. 3,000, right? And then you just copy and paste this formula, Control C, Control V, or you just need to Control C once and it copies the formula. And then now you see, and then we'll say that the first month is month 0 when you transfer the balance, that we were able to easily eliminate this debt in about 7 to 8 months, right? In about 7 months. Wow. I didn't think it'd be that quick. But that's the power of velocity banking. When you make your line of credit your main operating account, right? So all you do is just transfer these debts. Now, if the debt is not is too big, we're going to look for have some criteria of which debts we want to eliminate first. Usually, it's like the highest payment, lowest balance, highest interest rate, some sort of a combination, and we go over that in another video. But again, this is for newbies. But you can clearly see here that we kind of generated $1,000 out of thin air, right? And so we eliminated these two expenses, increased our cash flow by $1,000, and then we just every month it goes out 3,000, 3,000, 3,000 until we get to 0 right here, right? And so is it free to do it this way? Absolutely not, because when you use someone else's money, they're always going to charge interest, right? It's just a fact of life. Now, calculate the interest. Really easy. All you have to do is just get the last month's balance, so H2, right? Multiply it by the interest rate, which is 15, and you always divide by 12. Why do we divide by 12? Because interest rates are quoted annually, and if you want to get the interest for that month, you have to divide by 12. Now, technically, that's not correct because they do it by the average daily balance, but this is good enough, right? I'm not going to work hard just to get the minute details at the cent level, at the penny level. I don't need to do that because this is good enough for me. All right. So now I sum this up. I just click this button right here, auto sum, and see how much interest I paid. I paid about $1,250 to eliminate this debt within 7 months. So even though this interest rate is higher than this one, because our cash flow is a big number, to pay down that debt quickly within 7 months, yes, we have to pay, but we don't have to pay that much. In fact, if we just pretty much pay as is, I'm pretty sure this number will be smaller. And again, the calculations are kind of complicated when we talk about like, oh, at this balance, how much are we going to pay in interest? But my point is that if you just kept paying this at 6%, the monthly payment, you pay more interest with both of these loans than at the 1,200. And here's the other thing, you might say, hey, I could just pay my savings directly from here back to the loan. Yes, you can do that, and you definitely save money, but what's the problem? You lost your liquidity, right? So let's say you dump like $2,000 of savings in your student and auto loan, and so this kind of goes to 0, right? Well, what's the issue? Well, if you ever needed an extra dollar, you can't ever call the student loan company and say, hey, I kind of overpaid. Can I get my money back? Nah, they won't do that. They'll say, you're good. We're going to keep your money because that's just the nature of the product of the loan. But if at any time at the process, I need more than this $3,000 cash flow or more than the $2,000 expenses, because at any point, even though on average it's going down $3,000, if I need an extra dollar, extra $100, extra 50, we're good, right? We got that liquidity. So that's why you could directly overpay. And some people will advocate that like directly overpay, but like nobody does that. Everybody has the option to overpay their loan. But why does nobody do that? Because people know that their liquidity is important to them, right? So that's why nobody overpays loans, mortgages. You could save a ton of money doing that, but most people won't do that because they have no control of their money. All right. All right. So this is Korea Atlanta mentorship. So again, guide for dummies for velocity banking. I hope you learned something. Just learn the terms line of credit, get the strategy, paycheck, line of credit, expenses, line of credit, rinse and repeat over and over again. And then you pay off debt quickly to increase cash flow. Every debt that is paid off increases cash flow, and we're good to go. All right. Have a great day, everybody. And if you're interested in joining our group, I always gonna make a plug. You can join us by filling out the Google form link below and finding out more information, or you can email us by finding out our email address in the About page of our YouTube channel. All right. Have a great day, everybody, and we will speak next time.